Knowing how to ask for a loan for a business could set you up for a very successful and profitable business launch. But how do you go about getting a loan for a business if you don't have any provable revenue and you don't have proof that that business will be successful? Let's find out. In this video, I'm gonna walk you through the 5 things you need to know if you're gonna ask for a loan to launch a company. Because let me tell you, one of the biggest things we all struggle with when we launch businesses is where the heck do we get the capital to fund this thing? And if we don't have the capital in our pocket or in private investing money, how in the world are we gonna launch the business to pay for employees and inventory and trucks or whatever type of business we're starting? So sometimes we've gotta go get a loan. And let me tell you, some of the loans that exist for businesses today are incredibly powerful. Leveraging that money is a great idea, but you gotta know how to go about it and what banks are really looking for. The very first question you need to answer is how much money do you need and what it's gonna be used for. One of my favorite shows is Shark Tank. I love to see the different innovative business ideas that come, and they're talking to these sharks, and these business entrepreneurs are so brilliant. I was actually at a business conference a few years ago and heard Robert Herjavec speak, and his business thinking is so brilliant. But one of the things he mentioned in his speech was when he gives money to a company, he wants to know what it's being used for. And banks want to know the same thing. The reason is they want to make sure you know what you should know. Meaning, when you're going to take on capital, they want to make sure you don't just burn through that capital, because that capital is meant to do one thing. It's meant to propel your business to a point where you don't need the money. That's how you have to think about business loans. I'm giving you this business loan to help you go at a rate where you no longer need the money and can sufficiently and effectively pay it back. That's what people are investing in. And when you're thinking about banks, that's the question you need to answer. If you're leveraging a private investor who has equity in the company, the question isn't really about paying it back. For them, it's about when can I make a profit on that capital. But when you're asking for bank money, they're giving you money for one reason, so that your business can grow so you no longer need the money. I know it's weird, but that's what they're thinking about. So they want to know you know where to apply this money for true business growth. And a lot of this can be surfaced in a well thought out business plan. In fact, let me tell you this, a surefire way to get turned down by a bank is to go ask for a loan without a business plan. That's a terrible idea. So go to a bank and have your business plan all laid out. When you go sit down with a bank and say, here's my business plan, here's what we're creating, and this is why we believe this is going to be a really, really profitable business, and this is what we want the money for. When the business plan lays all that out, they know you've thought about this. My loan officer likened it to this one time. If you come to them asking for a business loan without a business plan, it's essentially like 2 guys sitting at the bar and one asking the other guy for money. There's no legitimacy to it. There's no idea of, will I get this money back, and is this money actually invested safely? Because let me tell you, when a bank loans on real estate, they're loaning on an asset they're sure will hold the value. When they loan on a business, they don't know if that person's just going to burn through that capital or not. So the truth is they need to be sure they're investing in a business. So understand, from a bank's perspective, they're taking on a lot of risk. They're investing into a business, and they need to know you know how to use that money correctly and that you're going to put it in the right places. And let me tell you, banks love to hear you say, I'm putting the money towards acquiring customers. Just to let you know, that's a side note. If they know you're putting the money at tracking down and getting customers, they know that will equal revenue. It's one of the best insurance policies against them loaning you money. So whatever your business plan is, make sure a big portion of that dollars is going to tracking down your ideal customer and getting those customers to pay you instead of another service provider. That'll impress a bank, and they'll feel a lot more comfortable than if you're talking about beautifying your storefront. While that's great, that might not bring in a lot more customers. And the second thing you need to do is decide what loan is best for you. What are the loans that exist that are really good for the type of business you have and what you want the money for? There's a couple different loans that exist for businesses. The one is just a simple bank business loan. They're usually 6 to 24-month loans in order to fund your business, so again, it can grow, pay the money back, and everybody moves on their merry way. So the bank really is a 6 to 24-month short-term loan in which they can invest in your business, help you get the business off the ground, and get that money paid back in a fairly short period of time. But when you do a bank loan, there's secured and unsecured loans. Secured is where you personally guarantee the loan. Unsecured is where you don't guarantee the loan. If you get a secured loan, the interest rates are lower because the bank sees that as a little bit less risky. If you get an unsecured loan where there is no personal guarantee, the interest rate will be much much higher, and quite frankly, it could kill the deal. A bank may not feel comfortable unless you really have some skin in the game. Because if you don't personally guarantee the loan and it can't really come back on you, then who's really taking on 100% of the risk? It's that bank, and they may not feel very comfortable with that. So just understand, you may have to personally guarantee a bank business loan. One of my favorite loans is an SBA government loan. And the SBA government loan, it's administered through banks, so you're still gonna get this money from the bank, but an SBA loan can loan up to 90% of the business startup cost. So if you're buying a business or you're starting a business, they can give you 90% of the money you need. So if you need $100,000, they can give you 90 of it, you come with 10, and you're off to the races. And plus, these government loans are very low interest, which that's what makes them so attractive. Another loan is something called a microloan. It's a loan of $50,000 and below, and it's usually, again, another short-term loan, fairly high interest loan in order to get you off the ground, and it may be a loan you think of to leverage if you don't need that much capital. Microlenders are usually banks that, again, will loan a small amount of money in order to get your business off the ground, and if you don't need that much capital, it's a great option. The next loan is equipment loans, and these obviously are very specific. The name says it all. If you have a business that needs equipment, if you have a excavation business or you have a HVAC business where you need trucks and equipment and tools, this can be a great loan in order to get your business off the ground by leveraging capital, low interest, and you can get all the equipment you need to start servicing customers. The last one's called accounts receivable financing. Banks will actually give you money based on accounts receivable. So if next month, let's say you have $100,000 of accounts receivable coming in, they will loan you money using that accounts receivable as the collateral. That money's supposed to come in, they will loan you money knowing that money's coming in. So if you know that money's coming in, but you're in a tight spot financially in your business and you need some capital to cover payroll or something really quickly, a bank can come in, loan you that money with the collateral of the accounts receivable. Again, accounts receivable of sales that have already been made, often the services have already been provided, and we're waiting for the money to come in. Because you may need money now, banks can step in and help you out, but they're loaning against or using the accounts receivable as its collateral. Before I go on to the next tips on how to get a business loan, make sure you subscribe to the channel as we give a lot of real estate investing, business tips, and money tips on this channel, really helping businesses and entrepreneurs grow their businesses and grow their lives. So make sure you subscribe, and let's get back to the video. The next thing you want to do is check your credit score. There's two types of credit scores: personal credit score and business credit score. Of course, if you're starting a business, you may not have any business credit score yet, so they're going to use your personal credit score. Now, if you've had a business in the past and maybe you sold that business and you want to start a new business, but you want to get a loan for that business or buy a new company, then they may take that business credit score that you've had over the years and apply it now. But check to see what that is. You might not have a business credit score yet. See what your personal credit score is, because the bank is going to loan based on those numbers, depending if you have one or not. If you don't have a business score, they're going to look at your personal. So check and see what it is, because when you go to the banks, they're going to want to talk through that, and they're really going to want to know that number. The next thing you want to do is assess your personal collateral. If you have houses or rental property or other businesses with equity in them, you can loan against those properties in order to get the business loan done. So if you have a property with $200,000 of equity in it, you can loan against that collateral and take a business loan. Now let me tell you, sometimes it makes more sense to get a business loan and using that as collateral rather than just taking a home equity loan from your property and investing that into the business, because the terms of a business loan may be better, especially if it's an SBA loan. They're going to give you 90% versus 80% of your equity. So you're going to be able to get more money getting a business loan and using that equity as collateral. And tip number 5 for getting a loan is ask until you get a deal. If a bank tells you no, keep going. If the next bank tells you no, keep going. Keep asking until you get one. When I first started in real estate, I got told no by some banks, and I kept asking until a bank said yes. The terms weren't great, but I got the deal done, and the terms kept getting better year after year after year because I became more of a trusted source to lend to. So if a bank tells you no, that doesn't mean every bank's going to tell you no, because different banks have different risks. Some banks will take really risky loans and just charge really high interest. So make sure you leverage every opportunity. Call until a bank says yes. Also, I want to give you a free gift today, the free business startup checklist. If you're launching a business, you need this checklist. Go into the description, click that link, you'll be taken to a page, get that checklist so you can make sure as you're launching your business and growing your business, you never miss these major important elements.